Hi there, welcome to Grain TV. I'm Kevin McNew. It's Friday, March 17th. Let's take a look at GrainEdge's trading platform and see what the trade action was like today. Grain started today at the 8:30 bell like most of this week, going to the downside. Beans stretched its losses down to $9.94, but managed to find some stability there and inched its way higher for much of the day. Going into the close, the markets were pretty listless for much of the day. Corn held a tight 3-cent range, but did manage to close at the high of the day. On the close, we had corn up 1, beans off 2, and Chicago wheat unchanged. Welcome back. Let's take a look at some of the news that's driving the markets here on Friday heading into the weekend. First of all, let's talk about the weather. And really, traders are looking at a warm-up in the southern plains as the cold front that blew through last week starts to abate. Other things that are going on weather-wise is there is a frontal system that is pushing into sort of the Missouri-Kansas edge of the region that may give some of the hard red winter wheat areas some drink of moisture, but it's largely expected to be confined to areas that are not susceptibly dry right now. Let's take a look at this map. This is the 7-day precipitation outlook from the National Weather Service, and what you can see in blue are areas that are expected to see the most precipitation in the next week with a ½ inch or more of rain. But the areas in green are expected to see a lot less than a ½ inch, down to a ½ inch or less. And those areas are the areas in central and western parts of the southern plains that are the most dry. So for the next week, it looks like very little chance of really sort of getting the crop drought situation in the southern plains changed about. As we look into the spring, we're starting to get some tales or get some forecasters to tell us what they think the spring and early summer may look like. Let's start first what NOAA came out with this week. They said that we're likely going to see a much warmer April, and we're likely going to see some moisture, above normal moisture in April for the upper Midwest, Iowa, Minnesota, North Dakota, South Dakota, and some potential flooding in that Red River Valley region. So that is potentially a double-edged sword. On the one hand, a warm weather event for April means an early planting season, but on the other hand, wet moisture, especially in the frost-prone areas of the upper Midwest, may lead to switching from corn into soybeans. So we'll be watching that as the early planting season progresses. Now, when we talk about summer, some forecasters are starting to say what they think might be on the cards for this weather, this summer for weather. And in particular, they're looking at analog years, or the state of the ENSO cycle, the La Nina El Nino cycle that tends to drive global weather patterns. And what they're saying is this year is very similar to 2006. Both Landworth and Planalytics are saying that this year's recovery from a La Nina and a quick turn into a potential El Nino suggests we may be in for a similar situation like 2006. Now, I caution you that this is not an exact science. They're just simply saying that the weather patterns we're seeing now are similar to what we see in 2006, not saying they will extrapolate out into exact conditions for this coming summer. But if we look at 2006, what you'll see is this western Corn Belt, upper Midwest, seeing worse yields than normal. In general, the U.S. average yield was off about 3% from trend, or 2.7% to be exact. But these other states in the upper Midwest were actually a lot worse, about 7% below trend. So that's something to keep in mind. But the real hedge here, if you will, is that the other analog years that these meteorologists are suggesting are like this year are in fact high yield years. So I'm not sure it's something you can take to the bank right now, but certainly there's the potential for a change in the yield outlook. Let's take a look at spot basis patterns over the last week, and when we look at this table, we see for the first time in a while some decent strength in the market compared to what we've been is pretty much flatlined to lower in the last few weeks. In corn, we saw a 1 cent average gain in spot basis around the country, largely driven by river terminals that were up about 2.1 cents a bushel, and processors that were up 1.9 cents a bushel. Now, in soybeans, we saw a much better clip at the river terminals. They were up 3.8 cents. Processors, on the other hand, or crush facilities, continue to drag, continuing to show no real incentive to bid it up. When we look at the charts that we've been following all season long, you'll notice corn continues, the river terminals continue to sort of trade around their long-term average. This blue line, the dark blue line is where we're at this year. The dashed blue line is where we have been historically for river terminals. And you can see, although we're off of it a few cents here in the last few weeks, we continue to sort of track that fairly well. So we continue to expect it to track close to zero as we get closer to expiration of the May futures. On the other hand, ethanol plants, while they have improved over the last few weeks, continue to be well below normal. Looking at soybeans, you'll see a much different situation with river terminals well below where they are historically this time of year, and again, expecting them to get closer to zero as we get close to expiration of the May contract. We would expect that river basis to really start to ramp up. We did see a 3 cent move this week on average across river terminals, but we'll probably see more of that over the next 6 weeks. So what are we looking for? Last week on Friday, we talked about our 6-week outlook. Now we're going to talk about our 5-week outlook. Last week we said corn down 10 to 20, beans up 30 to 50 over the next 6 weeks. We did get 10 cent move down in beans this week, only about a couple cents down in corn. So as we looked ahead for the next 5 weeks, I continue to expect to see more of the same. With corn, may have flatlined a little bit here. We've had good exports, we've had good ethanol production turned around sharply. We've still got uncertainty about the spring planting, and so that will probably keep this market stabilized here after a fairly steep slide in the last few weeks. So I would expect corn futures to be flat, maybe a little bit higher, but basis also inching higher would be my projection over the next 6 weeks, not necessarily moving sharply higher. On beans, I think there's still potential for more downside risk. We did get a 10 cent move down this week. So I would expect continuation of that with the pressure from South America. On the other hand, basis conditions should continue to improve as we need river terminals to start to bid it up to get closer to zero on the expiration of the May contract. So if that's your strategy, or if that's the outlook, then your strategy should really be something that separates your futures and basis opportunities here. Futures hedge is a good way to do that. Puts and calls are a good way to do that, but keep in mind that we probably expect more basis strength, especially in beans, in the next 6 weeks. So if you need to make a decision, those are the things you should be thinking about. As always, if you want help in this type of situation, Grain Hedge can help you not only lower your costs, but help you find the best cash market opportunities in your area. Give us a look online at grainhedge.com, take a demo of our trading platform, and see what we have to offer. Have a great weekend. We'll talk to you on Monday.